Welcome to Capitalists versus Consumers, where we break down how money really works and show you how to start building income that works for you. Today, we are answering one of the most common questions in personal finance. What exactly is an index fund? And why does every financial expert, every investing book, and every money podcast seem to recommend them? If you have been hearing about index funds but never fully understood what they are or why they are so widely praised, this video is going to clear that up completely. Quick note before we get into it. Everything we cover here at Capitalists versus Consumers is for educational purposes only and not financial advice. Always do your own research and consult a qualified financial professional before making investment decisions. Please hit the like button and subscribe so you never miss a report. Let's get into it. What is an index fund? Let's start with the most fundamental question. What is an index? An index is simply a list of stocks that meet specific criteria, used to measure the performance of a particular segment of the market. The most famous index in the world is the S&P 500, a list of 500 of the largest publicly traded companies in the United States. Other well-known indexes include the Dow Jones Industrial Average, which tracks 30 large American companies, the NASDAQ Composite, which tracks thousands of stocks listed on the NASDAQ exchange with a heavy technology weighting, and the Russell 2000, which tracks 2,000 smaller U.S. companies. An index fund is a type of investment fund that is specifically designed to replicate the performance of a particular index. Instead of a fund manager picking which stocks to buy and sell, an index fund simply buys all, or a representative sample, of the stocks in its target index in proportion to their size. So if you invest in an S&P 500 index fund, your money gets spread across all 500 companies in the S&P 500 automatically. When Apple, the largest company in the index, makes up 7% of the total index weight, your fund holds roughly 7% of its assets in Apple. When a smaller company makes up 0.1% of the index, your fund holds 0.1% in that company. You own a tiny piece of everything in the index, all at once, with a single investment. The difference between active and passive management. To understand why index funds matter so much, you need to understand the alternative, actively managed funds. An actively managed fund has a professional fund manager or a team of managers who research companies, analyze financial statements, study economic trends, and make deliberate decisions about which stocks to buy, hold, or sell. The goal is to beat the market, to generate returns higher than what you would get from simply owning everything in the index. This sounds appealing. You are paying experts to find the best stocks and avoid the worst ones. In theory, you should do better than just owning the whole market. Here is the problem. In practice, it almost never works. Study after study across decades of data consistently shows that the vast majority of actively managed funds fail to beat their benchmark index over the long term. One widely cited piece of research, the SPIVA report published by S&P Global, consistently shows that over a 15-year period, more than 85 to 90% of actively managed U.S. stock funds underperform their benchmark index. Why do professional fund managers fail to beat the index? Several reasons. Fees compound against you. Actively managed funds charge higher management fees, typically 0.5 to 1.5% annually or more, to pay for the research, the analysts, and the managers. These fees come directly out of your returns. An actively managed fund that earns the same gross return as the index delivers a lower net return to investors after fees are deducted. The market is very efficient. The stock market has millions of sophisticated participants, hedge funds, institutional investors, computer algorithms, all competing to find undervalued stocks. When so many intelligent people are looking at the same information, the chances of any single fund manager consistently finding opportunities others have missed are very small. Trading costs add up. Actively managed funds trade frequently, buying and selling stocks as their views change. Every trade generates transaction costs and potentially tax consequences. Index funds trade very rarely, only when the composition of the index itself changes, generating minimal costs. Why index funds win over time? The case for index funds comes down to one fundamental insight. If you cannot reliably beat the market, the best strategy is to own the market. An S&P 500 index fund gives you exactly that. You own the entire market, or a large representative slice of it. Whatever the market returns, you receive. And historically, the market has returned approximately 10% annually over long time horizons, a return that the vast majority of actively managed funds fail to match consistently. But owning the market is only part of the advantage. The other parts are equally important. Cost. The best index funds charge expense ratios of 0.03% or less. For every $10,000 you invest, you pay $3 per year in fees. Compare that to 1% or more for actively managed funds, which would cost $100 or more per year on the same investment. That difference compounds dramatically over decades. A 1% annual fee might sound small, but over 30 years it can consume a massive portion of your total returns. Diversification. A single S&P 500 index fund gives you exposure to 500 companies across every major sector of the U.S. economy. Technology, healthcare, finance, consumer goods, energy, industrials, all represented. No single company's failure can significantly harm your overall portfolio. This diversification is almost impossible to replicate by picking individual stocks. Simplicity. You make one decision: invest in the index fund, and the fund does everything else automatically. You do not need to research individual companies. You do not need to monitor earnings reports. You do not need to worry about whether to sell when a stock drops. You simply hold the fund and let the long-term returns compound. Tax efficiency. Because index funds trade infrequently, they generate very few taxable capital gains events. Actively managed funds that buy and sell constantly can generate significant tax bills even in years when the fund's overall performance is mediocre. Index funds minimize this drag. The different types of index funds. Not all index funds track the S&P 500. Understanding the different types helps you choose the right ones for your portfolio. Total market index funds track the entire U.S. stock market, not just the 500 largest companies. A total market fund like Vanguard's VT-SAX or its ETF equivalent VTI gives you exposure to thousands of U.S. companies, including mid-size and small companies that are not in the S&P 500. Many investors prefer total market funds for their even broader diversification. International index funds track stocks in other countries. Funds like Vanguard's VXUS give you exposure to thousands of companies outside the United States, in Europe, Asia, emerging markets, and elsewhere. Adding international exposure reduces your dependence on the U.S. economy alone. Bond index funds track bond markets rather than stock markets. They provide lower return potential but more stability, making them useful for investors who want to reduce the volatility of their portfolio. The Bloomberg U.S. Aggregate Bond Index is one of the most commonly tracked bond indexes. Sector index funds track specific sectors of the economy: technology, healthcare, energy, financials, and so on. These are more concentrated and therefore more risky than broad market index funds, but they allow investors to express specific views about which sectors they expect to outperform. Dividend index funds specifically focus on dividend-paying stocks. Funds like SCHD, the Schwab U.S. Dividend Equity ETF, track indexes of companies with strong dividend payment histories. As we covered in Day 33, dividend index funds are a popular choice for investors focused on building passive income. Index funds versus ETFs. What is the difference? You will often hear index funds and ETFs mentioned together, and the distinction can be confusing. Here is the simple explanation. An ETF, exchange-traded fund, is a structure for holding investments, not a strategy. An ETF trades on a stock exchange just like a regular stock. You can buy and sell shares throughout the trading day at the current market price. A mutual fund, the traditional structure for index funds, prices once per day after the market closes, and you buy or sell at that end-of-day price. Most index funds today are available in both structures. Vanguard's S&AMP P500 Index is available as both a mutual fund, VFIX, and an ETF, VOO. The underlying holdings are essentially identical. The practical differences are minimal for most investors. For beginners, the ETF structure offers one key advantage: lower or no minimum investment. Traditional mutual fund index funds sometimes require minimum initial investments of $1,000 or $3,000. ETFs can be purchased for the price of a single share, and many brokerages now offer fractional shares, meaning you can invest any dollar amount regardless of the share price. How to get started with index funds. Step 1. Open a brokerage account. As we covered in Day 31, the best options for beginners are Fidelity, Vanguard, and Charles Schwab. All three offer excellent index funds with very low expense ratios and no account minimums. Step 2. Choose your account type. A Roth IRA is the optimal account for most beginners. Your investments grow completely tax-free and withdrawals in retirement are tax-free. A traditional brokerage account works for amounts above the Roth IRA contribution limit of $7,000 per year. Step 3. Select your index fund. For most beginners, a single S&P 500 index fund or total market index fund is the right starting point. Specific options to consider: FXAX or FZROX at Fidelity, VOO or VTI at Vanguard, SWPPX or SWTSX at Schwab. All have expense ratios below 0.05%. Step 4. Invest your money and set up automatic contributions. Consistency matters far more than timing. Set up a monthly automatic transfer and invest regardless of whether the market is up or down. This dollar-cost averaging approach removes emotion from the process. Step 5. Hold and reinvest. The single biggest mistake index fund investors make is selling during market downturns. The entire power of index fund investing comes from staying invested through the inevitable volatility and letting compound interest work over long time horizons. The honest limitations of index funds. Index funds are not perfect. Here are the honest limitations worth understanding. You will never beat the market. By definition, an index fund delivers the market return minus fees. If you are hoping to dramatically outperform by finding the next great stock, index funds will not satisfy that ambition. They are designed to match the market, not beat it. They do not protect you from market downturns. When the overall market falls 30%, your S&P 500 index fund falls approximately 30%. Index funds provide diversification across stocks, but they do not protect against broad market declines. The long time horizon is your protection, not the fund structure itself. Concentration risk in popular indexes. The S&P 500 is heavily weighted toward the largest companies. As of 2026, the top 10 companies make up approximately 35% of the entire index. A significant decline in just a handful of mega-cap technology stocks could pull the entire index substantially lower. Total market funds and international funds help address this concentration. The bottom line. Index funds work because they give you the market return, which historically has been approximately 10% annually, at the lowest possible cost. They work because the vast majority of active fund managers fail to beat them consistently. And they work because their simplicity eliminates the emotional decision-making that causes most individual investors to underperform. Warren Buffett, arguably the greatest active investor in history, has said that for most people, a low-cost S&P 500 index fund is the best investment they can make. When the person who built a career on beating the market recommends owning the market for everyday investors, that is worth paying attention to. Start simple, stay consistent, keep costs low, and let the compounding work. That is a wrap on today's breakdown here at Capitalists versus Consumers. If this finally made index funds click for you, please hit the like button. It helps more people find this content. Subscribe and turn on notifications so you never miss our weekly breakdown every Friday after the close and our daily after the bell market report every trading day. We will see you in the next one. Resources mentioned in this video: The Little Book of Common Sense Investing by John Bogle, A Random Walk Down Wall Street by Burton Malkiel, The Simple Path to Wealth by J.L. Collins. This video contains affiliate links. I may earn a small commission at no extra cost to you.